weeks. According to this Pulte guy, President Trump and others in the administration are about to work on coming up with a 50-year mortgage. So the question is, would a 50-year mortgage work for you, or for that matter, anyone? To figure that out, I did what any self respecting personal finance nerd would do. I went and looked at a handy dandy amortization calculator. So, if you've never seen any of my videos before, my name's Chris. I am in higher ed and I'm a guy that loves to travel. This channel is dedicated to talking about personal finance, travel hacking, and the like. So, if that describes you, be sure to hit the thumbs up button, give the video a like, and subscribe if you've not already done so. I want to thank you a lot for doing so. Now back to the video. So, like I said, I looked up an amortization calculator to see how much a 50-year mortgage might cost. And to start out with, I wanted to come up with a basic idea of how much housing cost would be during this period of time. And this is from the Federal Reserve, and the most recent numbers show that the median sales price of a house in the United States, this is for June of 2025, it was $410,800. So when I plugged in my numbers into the amortization calculator, I started with a loan of $320,000, which would account for a 20% down payment of $80,000, give or take a little bit. Then I looked up current mortgage rates, and I went to CBS.com, and the current rate for a 15-year mortgage was 5.37%, and this is as of November 21st, 2025. This varies by the day. For a 30-year mortgage, it was 6.12%. The longer the loan, the higher the interest rate is usually going to be, and that's because the bank has an added risk. So the spread between the 15-year and 30-year was 75 basis points, or 0.75%. When I put it in for the next level, a 50-year mortgage, I basically used the same spread, and that's just a total and complete guesstimate, and that put us at 6.87% because you have to pay more to borrow for longer periods of time. So here's what the amortization schedule looks like for a 50-year loan, $320,000 at 6.87%. Your monthly payment is going to be, as you see here, $1,893.62. And over the course of 50 years, you're going to pay over $1.1 million. And at the end, you just own a house. You don't own any other investments unless you've been able to save in a retirement account or something like that. But $1,900 basically for 50 years every single month is going to go to a payment for the house that you're not going to make a whole lot of headway on. So if we look over here at the amortization schedule, it basically tells you by the year how much you can expect to pay off. And within 10 years, you've started at $320,000. You are down to just under $310,000. So you've basically paid $10,000 over 10 years. That's not a whole lot. You're not making any headway in terms of equity in the house, which is unlike what you're going to see with a 15-year mortgage, and to a lesser degree, a 30-year mortgage. But $1.1 million in overall payments, and it is actually going to be around year 39 before you start to make any actual headway with this payment, or year 40 when you sort of get even between the amount of interest you're paying and the amount of equity that you're building each year. So it's going to take forever to make any headway and actually get ahead with this kind of mortgage. To show you how bad a 50-year mortgage would be compared to a 30-year mortgage, I've got the same parameters with the current interest rate at 6.12%, which is what it is as of November of 2025. And you'll look here, rather than paying $1,892 or whatever dollars, you're paying $1,943. You're literally paying like $50 a month more, and you are going to pay off the loan 20 years before the 50-year mortgage. And you're going to make a lot of progress with the equity compared to what you're going to make the progress with under the 50-year mortgage. So, for example, after 10 years, we paid off basically $10,000. Under this scenario here, you have paid out over $50,000. So you've gained that much more equity for paying $50 more a month. And that is a big difference in the benefit. The total payoff, if you go to the end of the loan, instead of being 1.1 million, now it's down to 700,000. So you're doing a lot better in that regard as well. So just for funsies, I decided to look at the 15-year mortgage, and at the current interest rate, you would be paying off $2,600 a month. Your total for the 15 years would be less than $500,000, $467,000 roughly. In the 10 years that you would have paid off $10,000 of your loan under a 50-year mortgage, you would have paid off 130, you would be down to 136,000. You would have paid off about 114,000. That's equity that you would have in a house. If you sell the house, you're not going to be underwater. In most instances, you're going to be able to pull that equity out. You'll be able to get a home equity line of credit if you need to. If you've only paid off $10,000 and the house prices have not gone up, you're not going to be able to do that with a 50-year mortgage. You do have to pay a lot more, 20% more for your house payment on a monthly basis. But after the 15 years, you have the house and you don't have to pay that $2,600, or you don't have to pay that $1,900 that you would have had to pay under the 50-year or the 30-year mortgage. So you're going to save a lot of money in the long run. So what if you took out the 15-year loan and then you decided to put $2,600 a month for the next 35 years into an investment account that got you 8% interest? I got an investment calculator up, and that number will probably shock you. So let's say you bought your house at 30 years old and you got a 15-year mortgage. You would be out of debt by the time you were 45. Let's say that you had income coming in for the next 35 years, because 50 years minus 15 years would be 35 years. You invest the difference, or the house payment that you're not making for those 35 years. That will be $2,592.64, which is exactly what I got from the amortization calculator. Let's say you get an 8% return on an annual basis, and you put that money in, month out, the house payment you were paying under the 15-year mortgage. Let's say you put it in there, see what you got. You have an ending balance of more than $5.5 million. That's a pretty good deal. So you've got the house paid off and you have a nest egg of $5.5 million. If you get the 50-year mortgage, you have a house. That's it, right? You have a house. You might have been able to put the $700 difference, or the $600. Let's say it's $600 a month difference, and over a 35-year period, that would be $1.2 million. So the difference is going to be massive. The risk in terms of cash flow might be a little bit higher in the front end of that, but the long-term return is going to be a whole heck of a lot better if you're able to actually get a 15-year mortgage or even a 30-year mortgage, and then invest the payment that you don't have over a 20 or 35-year period of time. Is a 50-year mortgage a game changer in terms of house affordability? Not really. You're not going to save enough on your monthly payment to make it beneficial to you in any way, shape, or form. You're just going to wind up paying the interest to the bank in a massive amount early on in the loan, and not make any headway on paying off your loan over a 50-year period. Well, actually, for a 40-year period, then you start to get some traction around year 40. So this is not financial advice, because I'm not licensed in that regard, but the numbers seem to be fairly, clear that a 50-year mortgage is not going to benefit a whole lot of people, if anybody. So anyway, I hope you have found this educational and informational and entertaining. That's the main purpose, because again, I'm not a financial advisor. If you have found it beneficial in any way, be sure to share it, be sure to like it, be sure to subscribe. Thank you so much for watching. Until next time.